Hello, everyone. My name is Govind, and today I want to introduce you to CoOwn, a residential real estate co-ownership platform. CoOwn offers investors the ability to make direct investments in residential real estate properties with friends or like-minded investors. Real estate ownership offers investors long-term stable income, low correlation with other assets like stocks and bonds, as well as inflation protection in the form of capital appreciation. Real estate as an asset class is generally expected to provide higher returns than high-grade corporate debt at lower risk than holding equity investments. Private real estate investments often hold the greatest appeal for investors with long-term investment horizons and the ability to accept relatively lower liquidity. However, other than for homeowners, direct real estate investments has largely been beyond the reach of individual investors because of the large amount of capital required and the expertise needed to invest in the asset class, combined with its low liquidity. CoOwn enables non-high net worth retail investors to access this market in a collaborative way, and also offers investors the ability to sell their individual ownership, thereby enjoying some of the liquidity that indirect or public real estate investments like real estate investment trusts would provide. CoOwn is supposed to be a one-stop platform where you can do everything from finding properties on sale, find other investors who would want to invest in the same properties, collaborate with them to develop investment proposals, evaluate financing options, and then complete the registration process, all within the platform. And once your transaction has been completed, CoOwn also helps you find contractors for renovations or leasehold improvements, and a property management firm that will take care of the property's operations if you want a more hands-off approach. Let me tell you what makes investing through CoOwn more desirable than directly investing in properties outside the platform, and also through real estate crowdfunding platforms that happens to be CoOwn's biggest competitors. So investments made through CoOwn are structured as investments by LLCs. So how this would work is once you have formed a group and you finalize a property to invest in, CoOwn would work with our legal partners to help you set up an LLC. And one benefit of doing this is that, well, if you're investing in real estate, you would probably arrange financing. And when you're making investments directly, if you default on these loans, the bank will have recourse on your other assets. But if you're forming an LLC to make these investments, there's no recourse. So that's one benefit CoOwn has over direct private investments. Coming to crowdfunding platforms, these are structured similar to closed-end REITs. Although it is private investment in the sense that the platform does not trade shares of the asset publicly. This structure has a few drawbacks, especially when it comes to taxation. So both direct investing and investing through CoOwn allows you to avail some tax benefits, such as tax deductibility of expenses and depreciation. But this is not the case for crowdfunding platforms, where all rental income would have to be paid out as dividends, which would then be taxed at your marginal income tax rate. So your income yield under this structure would be a lot lower than investing directly or through CoOwn. Some other benefits of CoOwn include flexibility in choosing your co-investors and the level of involvement you want with the operations of the assets, while direct investment also offers these crowdfunding platforms do not. Now, the benefit is that once the investment decision is made, CoOwn, with the help of a legal partners, would take care of all registration and documentation needs. Well, this is the case for crowdfunding platforms too. You would have to do it yourself if you're investing directly. Another major drawback of direct private investment in real estate is that your investments are going to be liquid. So if you have urgent liquidity needs, you could run into trouble finding an off-taker to sell your property. The benefit of CoOwn is that the company would acquire your fractional ownership in the property in case you have an urgent liquidity need, or maybe you have some disagreements with your co-investors and you want out. Now, this would be at a discount to the fair market value of the property, but it would definitely be a much faster option than having to find a buyer yourself. While crowdfunding platforms would acquire shares at net asset value, offering better liquidity, if you look at all the other benefits that CoOwn has, compared to the crowdfunding platform, I think it's more than reasonable to say that CoOwn is a way better way to invest in real estate. So in essence, what makes us unique is that I think CoOwn offers the best of both of these worlds. Now let's look at the revenue model. So CoOwn hopes to develop in-house legal and property management capabilities by the third year of operations. Until then, we are going to depend on strategic partners to provide many of the services we offer to investors. In the initial stages, our primary source of revenue are going to be a 4% one-time charge on the sale price of the property, and also another $5,000, again, one time for all the documentation work. Our legal partners are going to help with the legal issues relating to registration, setting up LLCs, and so on. Those services are not included in the one-time charges that I mentioned before. Further, if you decide that you don't want to be actively involved with the operations of the property, CoOwn would also help you manage the property through our property management partners. So in the first 3 years, another source of revenue for us is going to be commissions from these strategic partners. Coming to what lies ahead for us, CoOwn will begin offering services in California, and we hope to expand to other states in subsequent years. The current plan is to expand to Texas in the second year and Florida by the third. As mentioned, we would be developing our in-house legal and property management capabilities by the end of the third year, which would enable us to move away from the commission model and have another source of revenue. Based on our current estimates, we expect to be profit generating by the third year. So these are our revenue growth assumptions. Might be a little hard to read, but to give you a rough overview, our base case assumption is that if we make the right moves, we would be able to capture 0.01% of the total multifamily real estate transactions in California in the first year. We hope to grow that to 0.06% and 0.11% in the next 2 years. In the second year, we hope to begin offering our services for properties in Texas. And our expectation is that with the traction we build in California, we'll be able to capture 0.02% of the market that year and 0.06 and 0.11% in the next 2 years. Again, we hope to begin operations in Florida in the third year and hope to have 0.03% of the market that year. And then we hope to grow that to 0.07% and 0.12% in the next 2 years. So this is our operating forecast. And this is a base case scenario for our operating forecast. And we hope to be profitable by the third year. At this point, we also expect other major players in the residential real estate space like Zillow to express interest in acquiring CoOwn. So I'll end here. I hope you enjoyed learning about CoOwn. Thank you.